US rates keep charging higher, forcing the Fed's hand as real wages tumble and political pressure builds. Options expiry will likely keep things choppy this week, and the weaker dollar helps fuel new highs in oil. All this and more in this week's Macro Insight. So welcome back to Macro Insight, everyone. Today is the 18th of January, and let's take a look at these markets. So biggest moves last week were obviously US 2-year rates. So despite markets already having that really aggressive sell-off in bonds the week before, and we were pretty weak in bond markets heading into that CPI print, which came in more or less in line with expectations. The yield curve still managed to take 2-year rates higher. They were up about 2.5 standard deviations, around 10 basis points. And we saw the yield curve flattening. So that dynamic continues. And obviously we saw stocks stay choppy with growth stocks, particularly on the back foot. So the sort of poster child of growth stocks, obviously being the ARKK ETF. If we have a look at that, see what that's been up to. So obviously it's really been the one taking a beating, right? The ARK. And you can see here, topped out back in March last year. Been consolidating for a long time, but we really had that acceleration now to the downside. So if we look at the entire rally from the lows in March 2020 up to the astronomical highs that it got to, pretty much multiplied by 5. I mean, we're getting to some serious retracement levels and actually breaking them now. Now, one saving grace, I would say, is, it's a hated sector right now. Cathie's been under fire. People love her or hate her, but it's just people have been very turned off by this and saying that these names are too highly valued and finally, everyone's dumping them. Now, I don't know whether the actual de-risking is finished yet. I mean, they may still have a lot of room to go, given that, they're still highly valued. But you look at some of the technicals and, you see the fact we've got back to this Fibonacci level off that entire rally. We're making new lows, yet the momentum isn't making new lows with it, which is potentially a bullish divergence. There could be a dead cat bounce coming, basically. I don't think it's much more than a dead cat bounce, but the truth is a dead cat bounce on this thing could take us up 15% quite comfortably, right? So something to be aware of, that if you do fancy these things are a bit oversold, then there might be some potential there. So that's what we're looking at in ARK, just keeping that one on the radar, right? And for people who believe in the whole exponential age story that Raul's been talking about, and you're thinking about these things on a 5-10 year view, then maybe starting to allocate into some of those things where you think that tech is really where the growth is going to come from over the next decade. That might make more sense, right? In the short term, expect volatility. Okay, in terms of macro data, the main thing was that big miss on retail sales. So, retail sales was expected to come in at minus 0.1, I believe, minus 0.1%, and it came in at minus 1.9%. Okay, so pretty bad print in terms of what we've seen in recent times. I had been saying, that the disposable income of consumers was going down last week. And yeah, we saw that come through in that print base. And then, markets took a bit of a slide on that news, selling off on those numbers, but then rallied back towards the close ahead of the long weekend, as they often tend to do in the S&P. So now we look at the Fed. Why does the Fed need to be so aggressive? There are some signs that inflation might be peaking, some of the forward-looking things like ISM prices paid, things like that, and growth might be slowing as well. Yet the rates market is pricing in 4 hikes, and it's also starting to price in QT. And you have Jamie Dimon there saying four hikes isn't enough. Basically, he's looking for like 6 hikes. Okay, so why does the Fed need to be so aggressive, and why is the market really going after that narrative and kind of pricing in such an aggressive Fed? And what it basically boils down to is real wage growth. Okay, so You've got Jim Bianco's put out some nice charts on this, where you look at inflation, but you look at inflation and you look at wages. So wages might be up 4.7%, I think that says, but that's with inflation at 7%. So if you basically take wages adjusted for inflation, then you can see that it's not a very rosy picture. Okay, so that is where the political pressure is coming from. Okay, so you look over to the chart on the right, Biden's approval rating is obviously been collapsing for a variety of reasons, but the big one is the fact that inflation is outpacing what people are making, what people are getting paid. Okay, so as that political pressure has been mounting on Biden, that has been the reason for the pressure on the Fed to shift away from a growth mandate, which they've been more focused on for decades, let's say, to an inflation mandate, which is now becoming unpalatable by the population. Okay, so that's kind of the reasoning. And then if we look at what the Fed's likely going to do, the previous hiking cycle, the previous tightening cycle, should we say, that started back in late 2014, that was when they were tapering, right? And we had a bit of a taper tantrum. They tapered, which means the balance sheet, which is this white line, stopped going up and stayed constant for a while. That was about a year, nearly over a year. And then they do their first rate hike. So they take rates up, Fed funds goes up there. And then over the course of the next 2 years, we see rates going higher. And then we start to see QT, which is the balance sheet, coming lower, basically, right? So that tightening cycle was spread over the course of, about 3 or 4 years, right? Before the market had a real wobble, right? And before and once they'd done the end of QE, stopped increasing their balance sheet, then started hiking rates, then finally reducing their balance sheet. Now, this time round, obviously, when we were easing, it happened super fast on the back of coronavirus, but we've been just sitting tight at rates at zero this whole time and the balance sheet increasing. And all of a sudden, the pressure's now on to get on top of inflation, and they're going to do everything in a matter of months. That's what we're looking at, right? And so that's the scary prospect here, that, they could just do all this amount of tightening in a very short space of time, or certainly they're threatening to. And what's that going to do to asset prices that are arguably quite inflated? Yeah, on a number of long-term metrics, right? So that's why the growth stocks are really getting beaten up and have potentially got a long way to go, right? So just something to be aware of. Now, looking at market price action, NASDAQ's probably really the thing to focus on, right? That's driving the volatility. So you've had, obviously, Spot Gamma have been flagging that the market's very much in short gamma territory here. So where did the Qs got down to? Around 370, which is down near this put wall. They then bounced pretty strongly, 5.5% in a matter of days. And now they're back down pretty much there again, right? So, very, very choppy price action in the NASDAQ, and not being helped by the fact that the street just doesn't have enough vol on the books, right? And it's chasing its tail whichever way the market goes. And, I've got the 1 hour chart there. These are 1 hour candles, and, it's kind of, and then I've got the ATR underneath it, which is the average true range. It's just showing you that on an hourly candle, the average hourly candle is like 3 points on the triple Q, which is the NASDAQ ETF, which is like 70, 80 basis points. It's winging around like 70, 80 basis points per hour, basically, on average. And that's kind of the type of vol we've been seeing, right? Given we got expiry this week, given we're firmly in negative gamma territory, I don't really expect anything to change, right? I think you're probably going to continue to see quite a lot of chop, particularly in the likes of the NASDAQ. So it's one of those things, you can choose to trade that chop and just kind of not get too big, but just trade the volatility, because there's probably going to be plenty of it. That might be an opportunity there, but I wouldn't really recommend building too big a position ahead of this expiry, basically. Yeah. Here you see the dollar. You got the positioning on the left and the chart on the right. So last week we were saying we were stuck in this range, and then we broke to the downside, and the level to really hold was 94.5, and it's kind of seems to have held that on the first try. But a few market commentators now getting a bit more bared up about the dollar. One in particular, Julian Brigden of Macro Insiders. He's kind of he's been a bit of a dollar bear for a while, but he's kind of now starting to shout about it a bit, thinking that the dollar could have some serious downside. Okay, so something to keep an eye on. Now, it seems a bit counterintuitive, right? Why is the dollar getting smoked when rates are jumping and the Fed is being super aggressive, right? And whereas the ECB kind of isn't. And it does sound a bit counterintuitive. Now, the explanation that people are giving is that, well, why has the dollar benefited so much, right? Because of this people needing to park their money in US stocks, basically, right? So there's massive flow into US assets because that's kind of been your only game in town, okay? In the low rates world, that's been a no-brainer to park your cash, okay? Now, if we're moving away from that dynamic and you don't want to be in US tech, right? And you want to be in value, then where's the value? The value is in international markets, basically. So the idea is you might see capital flowing a bit out of the US and moving towards some other markets, which is going to drive flows away from the dollar, right? So that's one of the reasons people are seeing there may be some dollar weakness coming. And typically you do see, you know, that dynamic when US rates do go up, you tend to see like value indices like Europe 600, the stock 600 do better than the likes of the NASDAQ or whatever, right? So something. And then if you look at the positioning on the left, we've got still a few longs in terms of non-commercial and leverage funds there. So does that help maybe mean that we need to see that go more towards neutral before this sell-off in the dollar is done, basically, right? So the sell-off in the dollar may still have some legs until we see some of that positioning data move to a bit more neutral, right? Often that positioning going into the start of the year, that consensus positioning often gets it quite wrong, basically, right? So it seems like that's the way it started off again. And it did the same thing last year. Everyone was super bearish on dollar and dollar just rallied from pretty early on, yeah? Okay, so that's what I'm seeing in FX. So should be able to see this, these commodity charts. So if we go through the commodities, what's going on? So gold, start with gold, going nowhere as usual, right? So you've had real yields, which is the red line on this top left chart. You've had real yields go from about 1.1 negative to 0.7, which is, you know, a 40 basis point rally in real yields. Normally that would crater gold and make gold drop quite significantly in the order of magnitude of, you know, 5%. Gold's just sitting there doing nothing. Yeah. Now you could argue that gold just wasn't buying real yields at negative 1.1 and was pricing in that that's just not sustainable. And so it never rallied, basically, right? So you can see here, whilst those lines were kind of sitting on top of each other for most of 2020, from about the middle of 2021, they completely diverged, right? Real yields collapsed, gold went nowhere. So that may have been the gold market just saying, you know, real yields are just nonsense and they're not reflecting what's really going on. And now that catch up has happened and gold has said, told you so, basically, didn't need to move. Maybe that's what's going on in gold. I don't know. That's kind of an argument that I've kind of been throwing around thinking about. But if it continues and we see real, now that it's caught up, then you could argue that whole divergence from late 2021 has been closed. If we get more downside in the red, i.e. more upside in real yields, gold's going to struggle to escape from that, I suspect, right? So the next move in real yields is really what matters for gold, not the move that we've just seen probably, right? So that's what I'm seeing in gold. In terms of copper, tried to play the break in copper, failed abysmally. Haven't been stopped out yet, but, you know, copper had a little go. The kind of reason I like the idea of playing that copper break was just that these inventories look very, very low, right? So copper inventories, LME, Shanghai COMEX, they're all very low relative to previous years. We were getting some nice rallies out of nickel, aluminium, etc. So I thought, okay, copper's been weighed down a bit by what's going on in China. Maybe now it's the time for it to break. So I did play that break of 450. It's at about 435, 440 now. I've got to stop at 425 basically. So I'm not going to get married to that position, but I've still got some long-term holdings in the pension that are going nowhere because I love that long-term sort of story in copper, but I was trying to play a tactical break and so far it hasn't really done me any favors, right? Okay, oil. Right, so what's been going on in oil? Oil's been accelerating to the upside, back through the highs, in fact, overnight. We had, despite Libyan production coming back online, didn't seem to care. Looks like the market's just got itself very, very tight. It's pricing in the end of Omicron. A lot of these OPEC producers aren't able to produce the quotas that they're allowed to produce, and they're struggling to meet the demand. So these are the type of things that are driving oil higher. Obviously, the likes of Cathie are massive oil bulls, and his narrative seems to be playing out, right? A lot of people, Goldman's put out a report calling $100 by the second half of the year. So there's a lot of oil bulls out there, basically. Now, personally, you can see that in the managed money positioning, right? There's a biggest uptick in that yellow line that we've had in like a year. So the spec money is flying into oil, as I said, needed to happen. I think it's got a little bit overblown, feels a bit overbought to me. If you look at the Bollingers, you look at like just how fast, sharp the rally has become. You know, I've taken a bit of profit. I obviously did buy into that dip in oil, as I mentioned to subscribers. I've taken a bit of profit and I've sold some puts instead, right? So it's like I've underwritten. So I've taken profit up here around $84, sold some 80 puts. So if it goes back below 80, I effectively buy it back at 80. Basically. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.